Hello again and welcome back to London. We now have tapering, so we can at least stop trying to double guess when that's going to happen. But what about the direction of the US dollar? Well, I've been to the offices of Alpari to talk the greenback ahead of NFP Friday. Craig, it's a big day on Friday, NFP Friday. We have that tapering decision now, so we don't have to talk about that. So what number are you looking for, and what will the implications be for the markets?
Well, I think the number we've had over the last few months in particular, the average number's been just below that 200,000 mark. So anything around there I think will be seen as a positive thing here. Anything above 200,000 will really justify the decision that the Fed made back in December, the tapering decision, which in all honesty I do think was the right decision, given that we had a couple of months of good data throughout that government shutdown. I think it was the right decision. Another some more good data in December would just really make it out like, well, yeah, that was exactly the right decision, justified the decision, and it would also justify the Fed's decisions going forward. So another taper in January, February, and in the months ahead, another $10 billion taper. I think that's essentially the plan that Ben Bernanke laid out in the press conference in December, was that we want to see a consistent reduction in the bond buying program, and then bring it to an end at the end of the third quarter.
Yeah, I know you said it's the right decision because you were telling me off camera that you called it right, the December tapering decision. But what does the Fed do now? Do they cut big chunks out of that bond buying program, or do they wait with the current reduction? How is it going to pan out, do you think?
I think they've got to be consistent, and I think they've got to be very open, they've got to be very transparent, and I think the only way they can really do that is by having consistent reductions. So these $10 billion reductions consistently. I don't think it's going to be every month. There's going to be occasions, 1 month, 2 month blips when we're going to see data that's not so great, when they may decide to hold off, and they don't want to risk the recovery just in order to stick by what they originally said and have it come to an end at the end of the third quarter and taper consistently 10 billion every month. But I think the general theme of it's going to be $10 billion every month, 1 or 2 months along the way where there's going to be no taper, and then if we get a couple of really good months, and we could see as high as 15, maybe $20 billion, especially if we've had a couple of blips along the way. But I think on average we're going to see that $10 billion a month. I think that's going to provide the least shock for the markets, and it's also going to give that investors that peace of mind that we're not going to see any shocks going forward.
Yeah. When we're looking at Forex, we often have to look at the fixed income market, bonds. What does the tapering mean for the Treasury yield, and what will be the implications for the US dollar?
Well, at the moment, the Treasury yield hasn't had too much of a shock, and I think a lot of it was priced in. I think a lot of it was actually priced in earlier in the year when people were expecting that taper in September, and we didn't necessarily see Treasury yields fall too far back. We saw them approach that 3% level, but then we didn't see them fall too far back after that, because I think people knew that we were only ever going to be a few months away if we didn't see the taper in September. And so when the taper decision came in December, yes, we did see a small increase in the Treasury yields, but we didn't necessarily see too big an increase that it caused too much of a shock or too big a spike in the yields themselves. So the threat from rising Treasury yields, or significantly rising Treasury yields, say on the mortgage market, on the consumer market, I think is going to be relatively small. With regards to the US dollar, I think everyone's really in agreement this year, which is quite surprising that we're going to see a strong dollar this year. I think people maybe anticipated earlier last year that in the latter part of 2013 the dollar would start to strengthen, but we didn't see that. We saw that consistent increase in the value of the euro, the pound sterling against the dollar. But I think most people now are in agreement that we're going to see a good year for the dollar, consistent tapering. Tapering is obviously positive for the dollar. People's minds are at ease over interest rates, so there's not going to be any panic that we're going to see interest rate hikes too early. Otherwise we'd see, I think, a much bigger rise in the dollar. But I think it's about time now that we do see that rise in the dollar. I think, say, euro dollar, I think we're going to see it fall back towards those 132 levels. Currently I think it's around 134.50. Sterling. Sterling's one of the only currencies actually in the short term that I actually see performing relatively well, just because I think the pound is such a strong currency at the moment. I think while the momentum may be lost a little bit, I think we are going to see it continue to grind higher. Things like the yen actually in the shorter term could still perform well, but I think the longer term we are still looking at those 105, 110 levels much further down. I'm looking at 6 months or so. I think we're probably due a little bit of a pullback now. It's been 9 weeks that we've seen the dollar rallying against the yen. I think we're due a little bit of a pullback.
Well, thank you to the guys at Alpari. Stay tuned to Dukes Copy TV for more interviews, but for now, goodbye.
you.